So in the last part, we had discussed these three problems of the share price valuation, the simple share with a finite case 1-year holding problem, the finite case multi-year, that is 3-year problem, where you had both dividend and a capital gain to be accounted for in the present value. Then we discussed a case of infinite case, where you are never going to sell the stock and all your future cash flows are going to be the dividends, and you apply a formula D1 divided by K minus G. Then you have this particular interesting problem which got interrupted in the last video. So we are going to complete this one here. This is again an infinite case. I'm not going to sell the stock here, but then I want the fair value of this stock provided that this company has a a tremendous growth for the first 5 years and then a normal growth for the next years till eternity. So after say 5 years, it continues to grow at 10% like any other relevant industry company. But for the first 5 years, it got some breakthrough, and it's growing at a supernormal growth rate of 20%, right? So hope that's clear to depict you graphically. So this is the earning of this company, earning per share or EPS or earning, and dividends will also be like that only. So exponential growth in the first 5 years, then normal growth in the so this is say 5 years time period, 5 years. After 5 years, it grows at normal growth rate of 10%, and before that fifth year, it was growing at a supernormal growth rate of 20%, right? So how do we solve this particular problem? We have to, of course, find out the same thing, the present value of the future cash flows, which includes both the dividends and the capital gain. This is a capital gain part of it, but before that, we need to understand that this is not a company which is going at a constant growth. This is a company which is growing at, say, supernormal growth rate for first 5 years. So the formula gets a little bit modified here, and the formula is something like this: D sub 0 multiplied by 1 plus h. What is this 1 plus h? It is a hypothesized growth rate, which we'll just talk about. And then for this hypothesized growth rate for, say, initial S years, you have to find compounded interest factor of annuity, compounded value of interest factor of annuity. So 1 plus h is again given by this formula, right? So apart from this V0 formula, you have to keep in mind this 1 plus h formula, which is 1 plus supernormal growth rate divided by 1 plus the market discount rate. So this is growing at 20% initially for 5 years, divide by the 15% market discount rate, and low, you got 1 plus h. And needless to say, h here is nothing but 4.3%. If 1 plus h is say 1.043, so you have h as 4.3%. Now coming to, so this particular part we can handle. Now what about this one? What about the selling price or the capital gain? So this will be, since it's a share held till infinite or perpetuity, which means that D6 will keep on growing at the rate G normal now, not supernormal, but normal now. So as we did in the previous example, question number 3, we can just plug in that value. So D6 will be D0 multiplied by 1.2 raised to the power 5. So this is what we have learned in the previous example, how you calculate this D6 given D0, the most recent EPS, most recent dividend, and multiplied by 1 over K minus G. So K here was, say, 15%, and supernormal growth rate is nothing but, say, 10%. Normal growth rate GN is nothing but 10%. So this 5%, and when you do that you arrive at a figure of this before plugging k minus gn, you calculated the d6, which is 5.474, and in the next step, in the very next step, you are going to divide it by k minus gn, which I was explaining just now. It is 0.05 here, as you can see, and what you get is of 5.74, which is the d6 divided by k minus g. This is the k minus g part here, and you get 109.4 as the present value of the capital gain, the selling price, not the present value of the whole stock, because the whole stock will have dividend for initial 5 years also, for which you wanted to calculate the CVIFA. Now 4.3%, this is what the H we were talking about. We got that H. For how long the company is growing supernormally? Company is growing supernormally for 5 years. So what you do, you plug in these values. So for any PVIFA formula, the formula goes like this: 1 minus 1 upon 1 plus k raised to the power n divided by k, right? So plug these values in and you get the CVIFA of 4.2%, 4.42%. And now we can calculate the present value of first 5 years dividend cash flow also, because you know D0, this is nothing but D0. This is next 1.03 is the 1 plus H part, which we calculated above, and next you have the CVIFA, which we just calculated here, right? You calculate both these values, sum it up, and you arrive at the answer that the present value of this stock should be 77.17. Fine. So another question which drives home the point of this share price valuation formula, here we instead of calculating the price, we want to calculate that k, or the internal rate of return, or the estimated return that we want. The recent dividend was 1.6. The stock is growing at 12%, similar to the previous one of the problems we have done in part 1. Share is today selling in the market at 20. So this is a fair value of present day, and we want to hold this share for 3 years, and we want to sell it for, say, 35 rupees. So what should be the market discount rate with which I can sell my stock for, say, 35 rupees? So again, like any other IRR problem, you sell it reverse. So what you have to do is that the sum of expected dividends plus the selling price should be equal to the present selling price, or the trading price of this particular stock. So what is the present value of all the dividends for 3 years? We did it in problem number 3. So the dividend multiplied by 1 plus growth rate divided by 1 plus k raised to the power n, and k is what we want to find out here, right? And the capital gain is, say, 35. The present value of that capital gain is 35 by 1 plus k raised to the power 3, because we want to hold this stock for 3 years. So this is the 3 here, right? And it should be equal to 10. Fine. So what we do now, we find D1, because this applies to not to the most recent dividend, but next to the most recent dividend, D1, not to D0. So 1.6 multiplied by 1.12, which is the growth rate, and you get D1. So you get D2, you get D3, because it's a 3-year finite case. So you can just plug in, you can discount all these D1, D2, D3, and K is something which is not known to us yet, right? And next, what you do, you add this value to the present value of capital gain, which should be equal to 2. Now what should happen? This left hand side should be equal to the right hand side. Now what does that mean? We can interpolate. For example, let us say for 28% discount rate, we get the left hand side as 20.83. For, say, 30% discount rate, we get the left hand side as 90.44%. And then you know how to interpolate. You can we'll shortly upload a video on interpolating if required, but assuming that you know how to interpolate, so between these k 0.28 and 0.30, our desired k has to lie. So you interpolate and find out that the internal rate of return or the market discount rate should be 28.86% to be able to, you know, sell this share at 35 rupees after 3 years. Fine. Now the question arises whether you know, this required rate of return is or IRR that we got is actually the required rate of return. So see, the required rate of return is a return which an investor should expect given the beta of the stock from the market, and given the risk-free rate and the market rate. So if you plug those values, the RF, RM, and the beta, you get the required rate of return. So suppose you get a required rate of return of say 20%, right? If you calculate from CAPM that your required rate of return is say 25%, for example, and what you get from the previous problem is that the solution of the previous problem is that your internal return buying this stock at 20, selling it this at 35 is 28.86%, which is higher than the required rate of return. So obviously an investor will invest into this particular stock. But if this comes out to be the required rate of return from the CAPM formula, given the beta and the market return is 30%, right? Suppose you know, this is in particular a high beta stock, or the market returns are too good, and my, you know, share is if bought at 20, sold at 35, given other values, is giving me a return of only 28.86, then probably it is not a good investment, right? So you can always compare this with the required rate of return obtained from CAPM. Thank you. Hope this all makes the concept of share price valuation better for you. Please don't forget to like, subscribe, and share. Thank you.